We've been talking a lot about market downturns recently, so let's talk a little bit about market recoveries and what they typically look like historically. I used this example back in 2008 when we had the big downturn. I said, it's during times like this that people say diversification is dead because a lot of times different areas of the market will move down together. And it's kind of like going to this party, I said. Now, let's say you're going to this party, you don't know a soul in this place, and there are hundreds of people there. You walk in, you don't know who to trust. There may be somebody that's in there that's an axe murderer. Maybe there'll be a bunch of narcissists or something like that. But there are going to be people that you can trust and people that you don't want to spend any time with. So you spend time mingling, getting to know some of the people, and you realize that there are people that can be trusted. They are decent people. Well, it's kind of like that with market downturns. When markets turn down, it may be some event that happens that causes all of them to go down a similar amount. But as changes take place and as we see what we're dealing with, different areas of the market may recover at different rates. So let's take a look at a few periods in history. Let's look at the 1970s when we had that big downturn, 73, 74. You see all these different areas moved down a similar amount and an aggressive portfolio went down about 36%. Now, over the next ensuing period of time that followed, you'll see that different areas of the market recovered at very different rates. And that light blue line was international small companies. They did very, very well. And then the red line was U.S. small value stocks did very, very well. How about if we take a look at the period of time after 9/11, 2002? And when we had 2002, we had that big downturn right after 9/11 because we didn't know what on earth was going to happen. We're looking here at terrorism and how widespread would this be and how big of an impact would be felt in the U.S. economy. Well, when we came out of it, we see that international small companies that just so happened did very, very well coming out of that. And U.S. small value did well. And then also international large companies did fairly well. Why? Because the dollar dropped in value. And that was very helpful to international. Then we look at the 2008 downturn. And in that, we had everything moving down a very similar amount. People said, hey, diversification's dead. It doesn't work anymore. But when we came out of it, we saw very dissimilar price movement coming out of that downturn, and not all asset categories benefited in the same way. Now, how will this particular downturn turn out? I don't know. Nobody really knows. But we realize that there's going to be a different world that actually emerges from this. Some people are saying that people aren't going to be getting together as much, that they're going to be doing more telecommunicating, or they're going to be actually online meetings, or who knows. But realize that it is not unusual for areas of the market to move down together, but come back at very dissimilar rates. That is probably about the only thing that we can expect coming out of something like this.